In the aftermath of World War I, from 1914 to 1918, the global economy began to recover and expand. The United States, largely untouched by the physical devastation of the war, emerged as an economic powerhouse. Between 1918 and 1929, the U.S. stock market experienced exponential growth, with the S&P 500 rising significantly. This surge was fueled by optimism, technological advancements, and a belief in endless prosperity. However, beneath this prosperity lay a speculative bubble. Many investors were purchasing stocks on margin, borrowing heavily to invest, driven by the expectation of continued market gains. This excessive leverage created a fragile financial system. When the market began to falter, margin calls forced investors to sell off assets rapidly, leading to the catastrophic stock market crash of October 1929. This event marked the beginning of the Great Depression, a severe global economic downturn that lasted until the late 1930s. In response to the economic crisis, the U.S. government implemented the Smoot-Hawley Tariff Act in 1930, raising tariffs on over 20,000 imported goods. The intention was to protect American industries and jobs by making foreign products more expensive. However, this move backfired as other nations retaliated with their own tariffs, leading to a significant decline in international trade. This protectionist spiral deepened the economic woes of the era. Fast forward to 2025, and we observe striking parallels. The global economy had been experiencing a prolonged period of growth, with stock markets reaching unprecedented highs. Technological innovations and globalization had fueled optimism, leading to high valuations across various sectors. However, concerns about overvaluation and excessive corporate debt began to surface. Amidst this backdrop, President Trump announced sweeping tariffs on imports, aiming to protect domestic industries and reduce trade deficits. This decision mirrored the protectionist policies of the early 1930s. The immediate market reaction was negative, with major indices experiencing sharp declines. Investors feared a potential trade war, reminiscent of the retaliatory measures seen during the Great Depression. Financial leaders voiced their concerns. BlackRock CEO Larry Fink warned of a potential recession, noting that stocks could plunge further. Billionaire investor Bill Ackman labeled the tariffs as a possible economic nuclear war, urging for a pause and negotiations. J.P. Morgan CEO Jamie Dimon highlighted the risk of stagflation, where the economy faces stagnant growth coupled with rising inflation. The similarities between the two eras are evident. Post-war economic booms leading to speculative bubbles, high levels of debt, and the implementation of protectionist tariffs in response to economic challenges. However, there are also key differences. The global economy of 2025 is more interconnected than ever before, with complex supply chains and multinational corporations playing pivotal roles. This interdependence means that protectionist measures can have far-reaching and unintended consequences. In both cases, tariffs were introduced with the intention of safeguarding domestic interests, but ended up exacerbating economic downturns. The lesson here is clear. While it's essential to address trade imbalances and protect national industries, it is equally crucial to consider the broader implications of such policies in an interconnected world. As we navigate the complexities of the current economic landscape, it is imperative to learn from history. Understanding the causes and effects of past economic policies can provide valuable insights into making informed decisions that promote sustainable growth and stability. Thank you for joining us in this exploration of historical parallels. If you found this analysis insightful, please like, share, and subscribe for more in-depth discussions on economic trends and policies. Your support helps us continue to provide quality content.